Oh, my hair's a mess. Oh, good morning, everyone. Welcome back. It's Tuesday. Your favorite host, Tim and Tim. We have another fun episode with our good buddy, Arn Cenedella. Arn, a quick little summary of Arn. He is been in the real estate industry for 45 years, and he started as a broker out in Palo Alto, California. He built a single-family portfolio in the Bay Area and Texas, and then now he lives in Greenville, South Carolina, and transitioned into multifamily investing in 2020, which is, surprise, surprise, relatively around the same time that Tim and I started to get engaged into the multifamily apartment space. His company or his group's name is Spark Investment Group, and is a GP now in 1,100 units with $140 million of assets under management. Arn, welcome, man. We were having some technical difficulties, but you made it finally. So welcome. How are you, man?
Hey, good. Thanks for your help. The technical difficulties were all on my end, so my apologies to everybody. But yeah, happy to be here, and I've been looking to connect and meet up with you guys again for quite some time. So glad we can find some time to talk real estate.
Yeah, it's fun, man. We've known each other on social media for quite some time. We may or may not have had a conversation or two on the phone or something like that, or like in Zoom calls or whatever. But I don't think you and I have ever met in person.
Correct. I've met Tim Vest at MFIN last summer, and we had a nice chat for about 10, 15 minutes. So that was good.
I remember that. Yeah, I remember him coming over and saying you just chatted with you for a while.
Yeah, I crashed the lobby.
I think you were crashing the conference. I can't quite remember, but
I didn't actually go in a room. I didn't actually go in a room. So.
That's the way you do it, though, right? That's the right way.
Nor did I take any water.
Okay, good. No dessert either.
No, definitely not dessert. Yeah.
All right, Arn. So yeah, man, why don't you give everybody a little bit more of a, kind of introduction to what you do, what your thought process, your unique ability in multifamily investing, why you're attracted to apartment complexes. And we'll just, we don't have anything scripted. We have no dedicated questions, and we just let the conversation flow. So we'll see where this goes.
Sure. So as you noted, I was a longtime single family investor. And then actually in 2020, I had a conversation with a local investor guy. You guys may know him, Mario Brown, Affordable Upstate here in Greenville. And he turned me on to a podcast about multifamily, and kind of a light bulb went off. And during the minor times we were shut down in the Carolinas with COVID, I just consumed podcasts, and then just decided to kind of move my portfolio into multifamily. And I'd say one reason was maybe greater cash flow than single family rentals. And then also the real thing I like about multifamily is the team aspect, where each member of the team can bring their unique skill set to the table. And so what do they call it? The sum is great. The whole is greater than the sum of the parts. So I knew I wasn't a great operator. And so I worked to find my primary partner, Brian Walsh, who is a great operator, takes care of the day-to-day, frees me up to kind of hunt deals, make contacts, raise capital, knowing that I've got a great partner to actually run the asset. And as you guys know, the operation and the property and asset management is really the key to most of these deals. So finding those right team members is important. And so it's great to have kind of a team effort, all moving in the same direction, which is to make good investments and provide good returns to our investors.
Yeah. Yeah. And Arn, I think you hit on something there. I just want to reiterate that, right? Like operations, right? Operations. And honestly, because Arn, you've been doing this a while, so you've probably seen this even in the single family space before, right? Like as what's going on in the market right now, like, people who have done some of this stuff who don't have that strong operator piece, it's a tough market right now, man. So
100%. So my dad was born 1921, so he's an old school guy, and he's went through a few markets, and he would say, well, it's time to tighten your belt. And so that's exactly what multifamily operators have to do now. They have to really watch that expense line, try to minimize expenses, maintain occupancy, maintain income, maintain collections. And so when the market's going crazy and cap rates are decreasing and interest rates are historically low, which doesn't mean normal, historic means historic, easy to look good. In times like this, you really have to have some experience and knowledge and expertise. And I think the other thing I would say is, for me, real estate's a long-term gain, and you can safely invest through any kind of market, provided you actually operate the business, operate the property properly, and you go into it properly structured. You're going to be able to survive a year or two downturn. So for me, what's going on now is nothing new. I've been through 3 or 4 of these cycles, and trust me, you just hunker down, you tighten your belt. When you come out the other end, the profits will flow again. And so it's just a matter of having kind of that long-term perspective and some operational ability.
Man, I want to take like that piece right there and just make it like its own little nest egg and just give it out to everybody, because that part is so critically important. And everyone, operators and investors included, had gotten so comfortable with what happened from 2020 until 2022 that became the new norm. And then when something doesn't go along the plan there, and there's distributions being halted across the board, there's increases in insurance rates, a lot of bridge products are becoming due, and even if you bought it right and you were conservative on your rents and your expenses, nobody could have predicted the 300% insurance increases, which is suffocating so many deals right now in terms of cash flow, which that makes investors upset, because now they're not getting their preferred return distributions. And you got to have a conversation with them and be like, hey, look, the preferred return is being accrued. You will get this money eventually. I'm sorry it's not right now, and this is what we had thought was going to happen. But here, you're part of the equity ride along this deal, right? So you're along with us, and we're not making money. You're not making money. Nobody's happy, but you don't really have a choice. And we're just going to hold this thing until we can come out on the other side. And it's just like been this big kind of clash that's been happening over the last 6 to 12 months about not getting my payments. I'm like, hey, if you wanted secure distributions where there was no equity upside and you were just getting your monthly interest, but maybe you should put it into a debt fund instead of in something that was on the equity side of any deal that you're doing.
100%. And I think it's when operators are talking to investors, they have to come to them from a place of integrity. And so I think investors who have been around the block a couple times understand there are factors outside an operator's control that impact the market. I mean, stock market investors know interest rates go up, the Dow Jones is going down. Has nothing to do with the companies they own. It's just the nature of the financial world. And what I tell investors is, number one, we can't control the Fed, interest rates, cap rates. We can't control the national economy or even the local economy. We can only control the operation of the building. And so the way I look at it is, if I do a good job operating that asset, I do a professional job doing it, I've met my fiduciary duty to my investors, because I've done the very best I can. I can't control what happens in New York or Washington or the Middle East. And so I think investors need to understand that. And I think as operators, as syndicators, if you communicate honestly with investors, don't overpromise. If people invest and have a good expectation of what to expect and how it works, when the inevitable bump in the road occurs, they're going to be a little bit better understanding of what's going on. And I think too many operators perhaps only focus on the potential upside and don't spend enough time communicating with their investors about the potential downside.
Right.
I think the other thing I would say is I'm kind of an old school guy. And so for me, if I can make 12, 13% on my money safely, that's fine. I'm a happy camper. So I think investors need to adjust their expectations. Yes, the boom days may return, or maybe they won't. But if you can get in a deal, make 12, 13, 14% on your money every year safely, to me, I would be happy as an investor. And so I think setting reasonable expectations given the tenor of the market is also important.
Yeah, that's a really good point. Those are really good points, Arn. And one of the things I think you said there is like, integrity and being, just being open and honest with your investors, right? Like, we've had recently some feedback from some of our investors that, hey, just let us know, right? We understand what's going on. Just let us know, right? Hey, this isn't going right. This isn't going well. These things are impacting the deal, and they're like, cool. Thanks for letting me know, right? Thanks for letting me know. And then being upfront with them, freezing distributions for some reason, right? Just saying, hey, listen, this is the time to stay cash rich, right? Like we need to make sure these deals have adequate cash on hand for whatever's coming. And in order to do that, nobody's taking money, right? And Tim and I try to be really, really upfront and just kind of say it real simply, which is, if you're not getting paid, we're not getting paid. Like, we're not taking fees if you're not making money either. So we're in it with you. And, and to your point, like, so far investors have really responded well to that. They're like, hey, thanks for being transparent about that. Right. So I think you're spot on. I think sometimes we as operators, we're a little nervous to tell investors the true story because we're afraid of their response. And it's like, I'd rather you hear it from me than someone else,
And what I have found in my life, when I contemplate an uncomfortable conversation,
blow it out of proportion.
Yes, the fretting about it is much worse than actually doing it, right?
Yeah.
You just address it head on, and then when you're done, you go, well, that wasn't that bad. And I think the other thing I'd say with you guys, I respect you a lot. I follow you. I tune in when I can. You have a level of seriousness and professionalism about this that I think investors can respect. And you lay it out to them. And I think the other thing is, it's one thing not to get a distribution. And I would submit most of our investors don't need that $300 a month distribution to live on, right? If they do, they probably shouldn't really be investing. And so what you're doing by pausing or reducing distributions, and on one of our deals here in Greenville, we've kind of cut the distribution in half. We're still sending a little money, but it's being prudent, because the last thing you want as a LP investor is your operator to call and go, hey, we need more money. That is Armageddon. And then then as an LP investor, you're really put in a difficult situation where pausing or reducing distributions, what that tells me as an investor, my operator is going about this in a mature, responsible way, and he's protecting our downside, as opposed to acting like nothing poorly is going on. It's more address reality and deal with it. And if you have to adjust distributions, that's just part of it. And again, I would say long term, the returns aren't going to be really negatively impacted by pausing the distributions. They're eventually going to be made. And the main thing is to keep the boat afloat during rocky waters.
Yeah, I mean, pausing the distributions, I mean, you're still accruing it, right? So you're still going to get the money. Yeah, your IRR probably going to go down a couple bips. Big deal, right? Now you're talking instead of a 16, 17, 18 IRR, maybe you're looking at 14, 15. but your overall return, your absolute dollar value stays the same. What's the difference? Yeah. Right? You know, and it's just trying to take that into perspective. And there's something that you said, and Tim Vest says it very, very well, is you know, when you're talking about managing the asset professionally and withholding your fiduciary to your investors, was, you know, Tim always talks about, well, hold me accountable to the things that I can control. I can control how this property is being operated. I can control, you know, vacancy. I can control, you know, general and admin expenses and property management and all these things. I can't control taxes. I can't control interest. I can't control insurance. There's a lot of things that I cannot control in this deal. And for better or for worse, I mean, there's a lot of people that are struggling because of two of those three things. And hell, I mean, even some of our deals in South Carolina had astronomical tax reassessments this year. I mean, literally floored us. And we have been arguing. We even hired attorneys to fight for us to get the taxes down. You know, and it's just, you know, that is us withholding our fiduciary to stay aligned with our underwriting as close and as best as possible. But there are things that you cannot control. And that's that, you know, the inherent risk of investing is coming along for the ride. Yeah. If you didn't want to come along for the ride and get, you know, potentially double your money in this set 5 to 7 year period, then don't ask for the equity, right? Then just get the interest position, and now you know exactly what you're going to get, right? So you can't have both sides, right? You can't have your cake and eat it too, and everybody wants to have their cake and eat it too. Hey, I would too, right? Why not? You know?
Yeah. Yeah, it just it's education. I think when you lay it out for people, they understand it, and I think also each operator has a certain style of investing, a certain approach, and so I think as an LP investor, you have to kind of find the operators who kind of approach investing the same way you do, and so. For me, I'm older. And by the way, I listen to you guys on Best Ever and Vital, your explanation about the velocity of capital. And, you know, I don't know how old you are, say 40 or 30, you know, I have no idea that at your stage, I don't know. I can't tell. I'm 60.
I'm 33.
So, okay. So you've accomplished quite a bit in that time. So for someone in your stage of life, really turning that capital over probably is more important than somebody like me who's 69 and has a certain net worth built up. And so limited partner investors should find operators who do the kind of deals that fit their investor profile for what they want. And so I'm at the stage of my life where I basically don't want to make any mistakes, and I'm willing to give up a little bit of a return accordingly, where other people at different points of their life could maybe be a little bit more aggressive. And so they should look for those kind of deals and the operators who do that. And so I think, coming back to your comment, the trouble comes in when the investor's goal isn't maybe as lined up with the investment and they don't understand it. They have to kind of evaluate that for themselves.
Yeah. I think that is very beautifully said, because it's something that everyone talks about. And I don't think anybody has talked about it in quite some time, but everything always comes back to a relationship, right? And if you are an LP investor looking to invest money as an LP, everyone always says, build a relationship with the person that you want to invest with first. Go meet that person in person. Go have coffee with them, have a couple of drinks with them, and get to know their thought process and their style of investing in order to make sure that the interests align. Because I agree with you. Like, I'm fairly young. I'm risking for the biscuit, right? Like, I want to move money. I want to turn it. I mean, Tim and I literally had a conversation last night about refinancing a property. I was like, dude, the ROE is like 3%. Why are we going to hold it? Right. But there's a certain level of cash flow that was there. And it was like, well, we could keep the cash flow, so the conversations are always there, but you have to build relationships with the people that you're investing with in order to make sure that your interests are aligned. So I'm so glad that you brought that up, because there are so many people that forget that fact. And there's the FOMO, right? I would give my money to Tim if I had any more. Yeah.
It's probably invested already. So that's
the other side of it is just like, the FOMO, right? It's like, I want to be able to move my money quickly, and I want to do all of these things, but I also want that level of security. And you got to pick one. Would you rather invest in Arn's style, where, hey, I'm going to be a little bit lower return, be a little safer, a little bit more long term, or are you going to go, with somebody that's more aggressive, that wants to be in and out of the money, that wants to, kind of turn it and burn it, but there comes a higher level of risk there, right? And it's,
right.
You got to have a balance in figuring out. And honestly, that's why, Tim and I do a lot of different kinds of deals. We have Class A product that fits more of your style. We have, product that we are looking at buying and turning around in 12 to 18 months. I mean, we're working on a flip project, just Tim and I and another partner, Chris. The goal with that was to be in and out in 6 months, right? So like, we have a variety of investments that we do in order to kind of have money in all those different buckets. But if you're working with a limited size bucket, you need to pick what's best for you as the investor.
Yeah.
Yeah.
Yeah. Well said. And Arn, I can't agree more. Make sure, because not to be the Monday morning quarterback here, but for a few years there, right, it was just like that FOMO thing was going big, right? Like, you saw all these guys like buying stuff and doubling the money in 6 months, 12 months, 18 months, whatever. And some of that got lost a little bit, right? Like, people were just jumping in and stuff like that. And unfortunately, there's folks getting burned right now. Like, you can't open LinkedIn, you can't open MoneyWise or whatever without another article about some operator going down. Real pay. Oh man, that one on Real Page last week was
that article.
That was a tough slap on across the face, wasn't
it? They tend to sensationalize a little bit, so
Sure.
I would take what they say a little bit with a grain of salt. There's a kernel of truth in there. Yeah. But they're trying to get clicks and eyeballs. But yes, there are certainly deals that are in trouble.
Yeah. So that's been one of the biggest things, like Tim and I see that. Tim and I see that, and we're like, oh, we need to make sure we're not the next article, right? Like, let's make sure we're not the next article. So like we were talking about before, being transparent, like not taking money out of deals, things like that. Because Arn, I don't go back as far as you do, but I was doing stuff, in the market crash in 08 and 09. And man, one of the biggest thing I learned from that one was cash flow would have saved my ass, right?
Mm-hmm.
Cash flow, having cash reserves in the account, not tapping them, would have gotten me through that 2-year window. And if I had gotten through it and come out on the other side, man, what I would have today, right?
100%. So what is the value of that property that maybe you had to sell in 2008 worth today, right? Right. So if you can ride through the storm, you come out and typically what I've seen in real estate, and I got into it in 1978, so I've been through a few cycles, is in my experience, you have 6-7 years of up. You might have 1 or 2 years of a pullback, maybe 1 or 2 years of kind of a plateau. And then that just sets the new floor for the next run up. Yeah. And so there's these cycles. And if you could get through it, and, I had plenty of rentals in 08 and 09. And yes, the value went down, but I didn't lose any of them. Because one, I didn't over leverage them, and they were all had fixed rate debt. And so, and even if the rents went down a little bit, no big deal. I was able to keep all of it. And so I just went into it. And of course, human nature is what it is. And when the good times are rolling, everybody wants to get in. And the other thing I would say is, the syndication space is relatively new. And by that, what I mean is really, it's only been available to, let's say, normal people like you and I and our investors since about 2011, 2012. And so the syndication industry as a whole has never experienced a downturn until now. People have short memories, but hopefully they understand in 2-3 years from now, when they're looking at another deal, understanding that building in a little protection on the downside at the expense of some potential upside may not necessarily be a bad thing. Where if your investing experience started 2016, then maybe that doesn't quite compute, where now it should compute for people.
Yeah. Hey, Arn, a question for you. So I like you said, like in 06, 07, I hadn't heard in our world, I hadn't heard the word syndication, right? Like I knew about it in the business world and and VCs and stuff like that, but I hadn't heard it really in the real estate space. So coming into 2011, one of the things we saw was lending was tight, right? Like real tight. Do you think syndication was kind of born out of that? Like, hey, how do we still get deals done without being able to go get a loan? Like,
yeah, good question. So, and I'm not an expert on this. There was some tax bill passed 2012 that kind of opened it up, and kind of made these investments available to more people.
Yeah.
But certainly, as in my lifetime, the price of real estate has always gone up. I don't expect that to change. Okay. And so, yes, as the price of these properties got more and more expensive, you have to pull more and more capital together. So I think the joint ownership is good.
Yeah.
And I think we all know contemporary society is super hectic, right? You guys are running, everybody, they got kids, they got work. So I think these group type investments really fill a good niche for people, because I think in general, people understand real estate's a good thing to own.
Yeah.
And they're either too busy or perhaps lack the knowledge to effectively do it. So I think we need to keep that in mind, is that people do like real estate. It is a good investment vehicle, but they just don't want to deal with the nitty gritty. So people like us open up those opportunities to individuals to do that.
Gotcha. Yeah, that's a really good point. And I like kind of what you're talking about there with, sometimes the group investments help, right? Address things like these ever increasing prices. And one thing like I want to go back to, as you said, over the course of your lifetime, because I think people miss this, right? Because you'll hear people say real estate always goes up, right? Especially some of the younger guys, no offense to the younger folks back at the last few years, real estate always goes up, right? It's like, no, over the course of this big window here, right? Real estate historically goes up, but there's dips in there, guys, right? Like there's dips. And I think it's really important to remember that,
And I find it's just kind of the natural cycle of life, right? Things are booming along. It's just, there's natural, I say, a little rain must fall, right? You're not going to have 365 days of sun. And of course, so my father taught me the real estate business, and he actually lived through the real depression. Okay. Not the Great Recession of 2008, 2009, the capital D depression. And so obviously the period you live in frames one's perspective.
Yep.
And he would say to me, and I have started investing in the San Francisco Bay Area, which of course has been the best residential market in the world for 30 years. But he'd always say to me, you got to look at your portfolio. What's going to happen if the inevitable recession or economic downturn comes? And you need to build your portfolio understanding those periods will come.
Yeah. Yeah. You, man, when you said you came from Palo Alto, I'm like, especially, you started in the 80s. Well, there was a little company out there that kind of started around that time that, that kind of caused that area to boom, huh?
Yeah, it's really fascinating.
They make these, by the way.
What's that?
I said they make these, by the way.
Yeah. So here's how old school I am. This is an AP12C calculator. Okay.
Nice.
And I swear to God, this thing is 40 years old.
I believe it.
So when I was a kid, in Santa Clara Valley, which is now Silicon Valley, Libby Canned Food Company was the biggest employer in Santa Clara Valley. It was basically an agricultural area. Yeah. And then when tech came in, it was just phenomenal. So I was blessed to kind of grow up there and be able to sell real estate there. That being said, I love living in the Carolinas, and as Carolina investors, we see population growth coming from some of these bigger metro areas into the Carolinas for a whole host of reasons. So I think we're well positioned for the demographic changes that are going to occur over the next decade or two here in the United States. So I love living here. I know you guys love living where you do. And so it has a lot to offer. And companies are coming in. So employers understand that. And it's a good kind of 1-2 punch for us investors.
Oh, absolutely. Couldn't agree with you more.
Yeah, Arn, kind of different, but sort of the same. Like you're talking about, speaking of the Carolinas, I remember as a kid, when IBM set up shop in RTP, right? And, folks so RTP's called loosely the Silicon Valley of the East. And, IBM kind of kicked that off, and now like Arn's talking about, the Carolinas is seen as like a budget, a growing tech hub, right? So
growing tech, and then of course auto manufacturing.
Yep.
And
all the battery plants and everything that are moving to the surrounding, like Greenwood and Florence, a lot of cities in South Carolina that are getting ancillary plants that are building things that support the auto and the tech businesses. So, man, buy anything in the Carolinas, or even, over to like Chattanooga, Tennessee, or, kind of that little area there. Buy anything in that area and you're going to do well over the next 10, 20 years.
And you think about the people who are working in manufacturing, they're our customer base in a lot of respects, right? Yep. They're exactly the kind of residents we want in our communities. And so it's a really good fit.
Yeah. I mean, everyone knows, we specialize in light tech and Section 8 housing, right? So buying in those cities are great for us because it brings more workers, it brings more vouchers, it brings more potential tenants. They're not building a whole lot of Class B and C product. So the more you can buy and hold on to it, the better you're going to do in those growing cities.
No Class B and C. I mean, I've looked at a few little development deals, and I don't know if you guys have started a few. I've been buying new product from builders at completion because I don't want to mess with the construction headache. But I think in the United States right now, it's kind of $200 a door minimum for a new unit. And,
absolutely.
And in major metro, like in Raleigh, Durham, it's probably three, so when you think about that, what kind of rents do you need to make those numbers make sense? And what percentage of the population can pay them? So if you can provide housing like in that $1,000 to $1,500-$1,600 a month, for me, that's kind of a sweet spot.
Yeah,
I agree with you.
Here in Wilmington, new product is going for $300 plus.
Yeah.
Average household, the average home sale price in Wilmington, I'm sure somebody like Alex McKinney, if you're watching right now, but like $400,000 or $500,000 is the average sale price of a house in Wilmington. It's insane.
Yeah.
Yep.
So.
And Arn, just a little shout out here, right? Like, what was the little spark in the Greenville Spartanburg area? That BMW plant, man. I remember when that thing went in down there.
So BMW, and then I think the other thing, and so I've been in Greenville since 2014. So the Greenville miracle has been going on for 20 years.
Yes.
I think BMW maybe came in about 25, and then GSP, the airport, came in. The other thing that Greenville really has going is the downtown is off the hook. And so
I love downtown Greenville. It's beautiful. You guys got so many greenways and stuff where people are walking along, and there's breweries along.
The
Mouse
Swamp Rabbit Trail. And yes.
Yeah. That place is great, man. Yeah. Greenville is a lot. I love Greenville. I think it's great. It's just too far from the ocean for me.
Yeah. I see your surfboard in back. And so I totally get that. One of my partners lives in Southern California and he's a big surfer. So he's never moving to Greenville. And that's the other thing, of course. What do we always say? Live where you want, invest where it makes sense, right?
Yep.
So that's the other part of the puzzle.
Exactly. That's why I live where I live.
All right. Well, cool. Well, man, we went a little long today because we got started a little late.
Because I was late. Bad on me.
All right.
I'll take 20 laps or do 20 push-ups as penance. Appreciate your patience.
I'll tell you what, Arn, Tim and I'll just take 5% in your next deal. How's that?
Okay. All right. Sounds good. Yeah. But it's been a pleasure. And I know we know a lot of the same kind of circle of investors here in the Carolinas. So look forward to deepening our relationship over time. And I just think you guys are doing a great job educating people and helping them on their financial journey.
Thanks, man. I appreciate that.
Well, feelings are mutual, man. Arn, I see your posts all the time, man. You're providing nuggets for folks that, quite honestly, man, people need to be listening to. So keep it up. I appreciate it.
Thank you.
So,
all right, folks. Well, appreciate everyone watching. Hope you enjoyed it, and we'll see you again next week. Peace.
All right, guys. Take care.